Yes, good evening. How are you? Can you hear me?
Yes.
Wonderful. So I just want us to take a look at just a few instruments, starting with the volatility 75. Then we'll look at other instruments that you might want us to look at. Right, so this is VIX 75. Let me just remove the moving average that I'm having there so that everything is clear. So as you all know that we always start our analysis from the daily. That I believe everyone now knows. So, can you see my screen?
Yes, I can see. So how are you?
Yes, I'm okay. Right. So after having gone to the daily, we actually need to identify external structure and also internal structure. What I mean by internal structure, I'm referring to these outside channels that you'll be having, because these outside channels, they help you when you want to take, for example, let's say you want to take swing trades. These external structures, for example, here, if you look at the market here, if you look at the market here on this zone, first touch was here, second touch was there, this was third touch. So there one could have actually taken a swing sell. Same as here, one could have taken a swing sell. So these are very important if ever you want to take swing trades. So right now, if you check at the bottom, if you remember what I said when you're drawing the top and the bottom of the channel, the top, once you have identified the top, for you to identify the bottom trend line, you go down to the low that created that high. This is the high. So the low that created that high, that is relevant. We go down. As we go down, we realize that there's this low, right? This low, the reason why I didn't take this one is because this one is cutting through the market like this, which is what I don't want. And it's actually also far from the market. So this one now is actually one of the best because it's very close to where the market currently is. So this one is the perfect downward channel trend line that we need for the bottom like this. So just simply looking at this and observing this, you realize that the market VIX 75 is in an overall downward channel, right? Overall downward channel. This is on a higher time frame. This is on a daily time frame, right? So meaning, if ever we are going to say we are now in an upward channel, it has to come and break outside of this and give us something like this. That is now the opposite of that one. So you realize that even here, those that have been following us for a while, you know that even here we were in an upward channel here. This was an upward channel here. Right. So this upward channel here, the market followed that upward channel up until it managed to break it. So after following this upward channel for a long time like this, the market eventually managed to break outside here, which was after the break there, we gave a long-term sell. Then as it came back to retest, we just sell. So basically, ever since that time that we broke out of the upward channel, ever since that time, the market has been in an overall downward channel and an overall bearish market. So basically, VIX 75 has been in an overall bearish market. Even if someone had sold and actually held their sell, right now they will still be holding in profit. So after having done that, we need to mark our major zones of support and resistance, or supply and demand. For example, this is a zone. After it was broken, this was a major resistance. As it came to the resistance, we could have sold, came to the resistance, sold. So the other trick now that I want you to know and want you to master, especially when you want to hold trades for long, for example, here, right? For example, here, I always taught you that if ever you want to look for targets, you always look to the left. So for example, after this break here, if you look to the left, the low that was there to the left is this low. This was the first low, right? So meaning this was going to be your first target for those cells. This was going to be your first target, right? First target, second target, this other low. So you realize that you could have actually held this trade for something like a week from here to here. Then it came back for a retest. After coming back to a retest, you look back to the left. Looking to the left, you're now looking at the most immediate low. You're no longer looking at these ones. You're now looking at the most immediate low, which is this one, right? And if you check, the market actually came all the way and touched the level. So why am I telling you this? Is so that you know that the market, it always moves according to these major levels. It always moves according to these major levels. If it's coming from one major level, it will push all the way up until it reaches the next major level. So from here, the next major level, I was looking at this low. It was reached. This was actually 1, 2, 3, 4, almost a week of holding. It went back up, back to that major resistance. Then you look back to the left. Looking back to the left, you realize that the previous major low was this one. Meaning you could have held this trade for 1, 2, 3, almost 4, 5, 6 days of holding just from day to day. So that is one technique that you can use if ever you want to hold, because the market, if ever you want to make the most money out of the market, it's someone who is actually holding their trades for long, because the market, it moves from major levels, one major level to the next major level. So if you're someone who is always entering and coming out, you realize that most of the times you're going to have a problem, because there are moments where you can't even enter. I've told you that there are zones where, for example, when the market is fluctuating, those are zones where you can't enter a trade. You actually need to wait up until that fluctuation zone is ended. So when there are moments like that, those ones who will be in the trade are the ones who benefit, because they are still they'll be in the trade even if the market fluctuates. So that is why it's very necessary for you to start your analysis from the higher time frames. Once you have done your analysis from the higher time frames, identify the major levels, identify the major level where the market currently is, and the major level where the market most probably is targeting towards, right? So from there, if ever you look to the left, the next major target was these lows here. This was the next major target. These lows here, of which the market actually came all the way and reached the lows like that. So after having done that, the market established this as a major resistance. After it was created like that, obviously, you know that after a break and retest of a major level like that, you could have taken this sell. This was a simple trade that one could have taken. Break and retest, you could have taken the trade there. So many other confirmations you also use for your trades, as we've always been telling you. So here I'm simply trying to show you how you could have identified counter trends in that major downward channel, in that overall downward channel. It doesn't mean that there were no counter trends. Counter trends, like these are the channels that I'm showing you. These counter trends, which the market was actually uptrending like that. So many counter trends, you can actually see them.
Mostly.
Trend line.
You get it, Auntie.
Who's Gary's name?
I'm not so I don't know anything. You need to.
So these were the counter trends that were happening, in as much as we're in a major downward channel. These were counter trends that were happening all the time. So after the break of the counter trend, you know what you do. You always join in the cells here. After the break and retest, you could have joined the cell. Looking at the major structures, your target now was this major low. This was a major target that you could have looked at, right? So from this entry here, from the entry here, your major target was the low, the previous swing low, which was this level here. From day to day, that was a trade that was actually worth taking. Same as here, after the break of the counter trend, you You could have gotten that entry on a smaller time frame, whether it's 15 minutes, 30 minutes, 1 hour. You could have gotten that entry. You could have gotten this entry. You could have gotten this entry. Your target, same target. You always look to the left. Swing low. Previous swing low was this one. So these are some of the major trades that one could have taken all the while on VIX 75. Same as here, after breaking, if you check this down on this channel here, this channel after it was broken like that. So after it was broken, the next major level that I'm looking at is this zone, this resistance, or these highs here, or this previous highs here. The previous major highs were here, right? So after I look like that, what I simply do, once you enter that trade, you always know that the market is always going to push to the next major level from that one. So from here, after breaking that channel, the next major level was here, which was reached. So I'm simply showing you this so that you know that the market always moves from one major level to the next, If you don't know the current major level that the market is in, or the current major level that the market is heading towards, if you don't know that, you are just going to be entering, coming out, because you don't know what you're doing basically. If you check here, the market established this resistance, touch, that's a major resistance. So once we have established a major resistance like that, remember we're in a major downward channel, and when we're in a major downward channel, all our selling opportunities, we always take them. All selling opportunities, we make sure that we take them. All selling opportunities, we make sure that we take them. So after establishing that resistance, we notice that the market, so from that resistance now, where is the next major target? We look at the previous, to the left, major swing low, previous swing low was this level, right? So that level, if you check, the market came all the way and reached the level, came back all the way up, right? So here I'm simply showing you how to identify major levels, simply using support and resistance and trend lines. That's one way of identifying your major levels. So there are other ways which we actually started to teach in Smart Conference Trading 3.0, where we now talk of supply and demand, where we now start to talk of order blocks, and we're still teaching much more on that. So support and resistance and trend lines, it's one way of identifying your major zones, right? Supply and demand, it's also another way. Order blocks, it's also another way. Fair value gaps, it's also another way. So all these ways are simply ways of identifying your major levels. But simply, here I'm simply showing you the simplest way, which is by use of support and resistance. So from here, after the market came back all the way up here, came back all the way up there. So right now, after coming back all the way up here, I want you to take note now of what happened here. So what happened here was, I want you to look closely. The market was going down, lower high, lower low, lower high, lower low, right? So from this lower low, it pushed all the way up, created this higher low, which is higher than this one, right? After creating this higher low, it failed to make a higher high here, right? Which gave us a double top. And what you know about double tops is that double tops are reversal patterns. Once you have a double top, you always know that the market is about to drop. So after failing to create a higher high than this one, the market came and broke this previous low, which was a higher low, right? So that break now, once we have that break, we call it a change of character. We call it a change of character. Why do we call it a change of character? We call it a change of character because the market was now forming bullish market structure, and it actually broke that bullish market structure. This was a higher low. According to bullish market structure, it was supposed to do this higher low. Then here, it was supposed to give us a higher high, which it failed. It was supposed to come, if ever it respected, it was also supposed to go and continue giving us higher highs, higher lows. That is the law of a bullish market structure. But actually here it was broken. So the law of a bullish market structure, where was it broken? It was broken here. Here. Can you see? That was where it was broken. it was broken there. So after being broken there, that's what we call a change of character, right? After a change of character, it means the market it's now doing the opposite of what it was trying to do. For example, here it was trying to be bullish. So meaning after a change of character, we are now looking forward for the market to drop. So after a change of character like this, which was here, after a change of character, the market always gives us a pullback. The pullback either happens into a resistance, fair value gap, or an order block. Any of those three, the market gives us a pullback. So when it comes to pullbacks, we can also use Fibonacci. We can also use our Fibonacci retracement to identify that. So this was the level. This was the level. This was the level here, right? So this was the level. That is what we call an order block. One can call it an order block. Another person can come and call it a supply. An order block or supply, that is the last bullish candle before the market went down. That is what we call a supply or an order block, right? The last bullish candle before the market dropped. The last bullish candle before the market dropped is this candle here. Let me put this, okay. Right, the last bullish candle before the market went down. Before the market went down and changed character. Before the market went down and changed character, where is our last bullish candle? Is this candle. That is what we call a supply zone or an order block. Whichever way you want to call it, you are all correct. So supply zone or an order block, you are all correct. So once you've identified the level, like that, you mark it. That's an order block or a supply zone. So once the market has managed to change character like this, it always comes back either to the order block, to a fair value gap, or to a resistance. So this is an order block. As I said, the last bullish candle before the market dropped. Before the market went down, the last bullish candle was this one. So that's our order block. Then there's what we call a fair value gap. A fair value gap, it's the gap that you find in between candles, right? If you look at candles, if you look closely at your candlesticks, they have a low and a high. Every candle has a low and a high. So if we mark the lows and the highs, remember we spoke about lows and highs in Smart Conference Trading 1.0. This is the low of this candle, right? Then this is the high of this candle. This gap in between this low of this candle and this high of this candle, the gap from here to here, this is what we call a fair value gap. This one, the high of this one, and the low of that candle, which was here. This gap here is also a fair value gap, even though it's small. So the bigger the fair value gap is, the more the market prefers to go to that zone. The more the market prefers to actually retrace back into that zone. So fair value gaps, order blocks, supply and demand is also another way of identifying major zones on the market. So for example, here, the major zone here was this order block. So from there, where is our target? So from there, one could have entered a sell. Obviously, you enter your trades 30 minutes to 1 hour, you could have gotten a smaller stop loss. You could have gotten a smaller stop loss. You could have entered your sell there. Target, you're looking to the left. Where is your previous low, which is this level, right? You could have sold all the way to that level. 1, 2, 3, 4, almost 5 days of holding this trade. You would have made your money just like that, just by simply holding from that major zone to this major zone. So now, what do we do after a major zone has been broken? After a major zone has been broken, I always told you that there are 2 ways of entering that. Either you enter immediately after the break, or you can also enter after the retest. Both ways, you are still correct. So right now, where is our next major zone? Our next major zone right now, it's based on a trend line now. This trend line that we drew, that is the only way we can identify the next major zone. So right now, the next major zone, I'm targeting the market to drop all the way here before maybe shooting all the way up, based on the channel that the market has created, based on the channel that I just showed you. So the next major zone right now is this zone here. So after I've marked my major zone where I'm targeting the market to go, I now look for an entry point now. I'm now looking for an entry point. So the market is downtrending, as you can see. We are in a downtrending market. How do I know that we're in a downtrending market? We can actually see that we are now forming lower highs and lower lows. You can actually see that we are now forming lower highs and lower lows. Let me just, we are now forming lower highs and lower lows. So this level here, it's actually a support zone. This is a support. This is a support that the market created here, right? So one can say after the break of that support, I'm actually going to enter my sells. That is a very good entry point. That would be a very good entry point. So one can wait for the break of the support for them to enter their sells up until they hold the sells all the way down there, right? So right now, after you've done the analysis on a higher time frame like this, going down to lower time frames, you're simply going down there to get your entry points and to get any other further confirmations. For example, there's this trade here, this trade that we didn't give the signal, but those that have been following us, they actually know this retest here. This was a retest into this resistance. One could have actually sold here, sold there. Your target, first target, is this previous low, which is this level, which has been reached, which was that level of support, which was the target that it's actually reached. So right now, once it's broken, we are now looking forward to this major target that we saw on the daily. So this was the current trade that one could have entered on VIX. And also I saw this other counter trade that one could have taken. There's a counter trade that I saw, which was a buy actually previous, I think was it last week or so, or this was a counter buy. You could have gotten that buy easily if you went to 1 hour, 30 minutes, you could have taken that buy so easily. On smaller time frames, your target is simply the resistance that we drew, the major resistance that we drew on a higher time frame. If you take note of why I'm not even mentioning or talking about the resistances that you'll find on 15 minutes, 30 minutes, 1 hour, why am I not talking about these resistances? This resistance, in as much as they are there, they are okay. It's not like they're not resistant. They are resistances, but those resistances, they are less stronger and less effective than the higher time frame resistance. So the higher time frame resistance, the market prefers to go to those ones more than these smaller time frames resistances. These smaller time frame resistances, you can simply use them for shifting your stop loss or for adding more trades. For example, let's say this is a resistance, right? This is a resistance. Let me mark another resistance or another level. This is also another level here. This is also another level. So these levels, you could have simply used them for either shifting your stop losses or scaling in more trades. That is the purpose. That is the whole purpose of this smaller time frame resistances. So if you check this counter trend line, touch, broken here, retested. After the retest there, that was a trade that one could have simply taken. Simple trade that one could have taken. You enter there, your stop loss just below the trend line or just below this support. Your target, you are using the major time frame target, which you saw on the daily, which was there. These other smaller time frame resistances, you simply use them to shift your stop loss. You simply use them to shift your stop loss. Right now, I'm talking to someone who wants to actually get maximum returns from the market. Someone who wants to get maximum returns from the market. That is what you do. You do exactly what I'm telling you now. If ever you want to get maximum returns from the market, you follow what I'm saying. Follow higher time frame levels, higher time frame zones. Use those ones for your targets. Once you use those ones for your target, it means you're going to get maximum returns for each and every single trade opportunity that you're going to get. So this was a buy, simple buy. Then there, I told you why we entered the sale is because it's simply a retest to a major resistance that was created on a higher time frame. So one could have entered that one based on that resistance, or also based on the counter trend line that was there to the top, which was this trend line here. this trend line, counter trend line there. This counter trend line broke, retest. Either you could have entered there at the top or entered here as well. Both of you, you're correct. Whether you enter there or you enter after the break of the counter trend line, which is this one, yeah, we are both correct. We are both correct in as much as one entered earlier and the other entered later. But we are both correct. So these are two trades that one could have simply entered. Two simple trades that one could have entered, simply following what I'm telling you now, simply following what I'm telling you now. So right now, we have this major support, touch, touch, touch. So right now, what we want now is for the market to break and retest. Once it breaks here, give us a retest, we can simply start entering more sells, because we are now targeting that target that I showed you on a daily time frame. That is the target that we're now be looking at. So here, simply wait for a full breakout. Once you get a full breakout, once the candle fully closes below the zone, once it closes below the zone, you enter your sells, or you wait for a retest. Once you get the retest, you also. So a retest is simply a further confirmation to say, indeed, we've broken out. For example, here we broke, then the retest. The retest is simply a further confirmation to say, indeed, we've broken out. So once it manages to do that here, we are simply going to enter sales. The target, I showed you the target based on a daily time frame. I showed you the target. So if ever someone is simply looking at these smaller time frames, where are you going to get the target? You never see this target. This target you only could have seen, you only see it if ever you are someone who follows what I'm telling you, which is following top-down analysis. So here we want a break, retest, then boom. This is the target that we're looking at. From this zone, we are all going to buy. We are expecting buys from here, because according to how we trade channels, we sell the tops and we buy the bottoms. This is the bottom of the channel. We buy. Then according to channels, we can actually hold all the way to the top if it comes all the way to the top. But even if it doesn't come all the way to the top, we simply follow major levels of support and resistance that will be there along the way. But so far, this is what we are looking forward to on volatility 75. Anyone with a question on volatility 75? Anyone with a question?
But I think it's clear because I also entered the trade that was yesterday. I entered based on the counter trend. The moment it touches the support, which is broken, it tested the support. Then I just took the trade on the counter trend of the line that you just put there. So I'm still holding my trade right now. It's run, yes, there. That's why I took the trade. Yes, exactly. Yes, exactly. There. So I'm running a trade. I just took it with 002. So I'm still holding the trade until now. So I'm expecting it to go down to the target of a daily time frame, because I just did the trend channel in a 4-hour time frame, because I've come to notice that some of the hours they are really faking, because like whenever you wanna take a trade, like maybe in 30 minutes, maybe 15 minutes, there's too much fake. But I noticed that 1 hour it's at least more when you want to take a long team trade. So based on 1 hour, but my trend line, it was in a 4 time frame. So I got it in 4 time frame there. I'm still holding it. Just that the day before yesterday, I was really broken. I was really broken because I took almost 6 trades for is it crash 500. I almost took 5 trades. So I told you it went against me. I was holding it. If you remember, I asked you if it's for long term. So I hold it. I'm telling you, it went back, and it takes me out. It almost hit me $50. Just took everything. So I was really broken. But I said no. I'm gonna catch it back. So I'm just on the VIX 75, yeah.
All right, all right. Okay, okay, it's okay. So I hope you are getting the logic here. This smaller time,
Yeah.
15-minute, 30-minute, and even we use them for entries, right?
Hmm.
The higher time frames are the ones that you must use for your analysis and your targets. I hope I'm clear on that one.
Yes. Yeah.
So the smaller time frames, you can use them for your entries. You can also use them for shifting your stop losses. You can also use them for scaling in more trades. For example, this dropped, came to this low here. So after breaking this low, one could have shifted their stop loss either to break even or just above here. As it came and established another level, rock like this, you could have shifted your stop loss all the way down here or above here. So right now, I hope already you have shifted your stop loss at least halfway of where the market has moved.
Yes, exactly. I'm still shifting my stop loss.
Wonderful. So you shift your stop loss based on this. You can use these smaller time frame levels to shift your stop losses. For example, this is the other level that I'm actually seeing, right? So right now, your stop losses, you can actually be, right now, they can actually be either above here. They are safe above there, right?
Okay.
They are safe above there. So even if it comes and takes you out there, you know that at least you've closed maximum profits. So even if it comes and breaks below here, you know that I can now shift my stop loss at least to this other level that is down here, this level here. If it breaks here, you shift your stop loss just above the level here. So that is the whole logic. The market moves from one major zone to the next. The market always moves from one major zone to the next major zone. So once you identify your major zones on the daily or on the weekly, daily, weekly, whatever, once you identify your major zones, once you've identified them and you notice where the market currently is it coming from the major zone? If it's coming from the major zone, are you buying or you're selling? Then you identify the next major zone that is there from where the market currently is coming from. Once you have identified those two major zones, that is your current range that you'll be trading.
Hmm.
For example, here one can say our current range with this major resistance. Where is our major support? Major support, one can say this previous low here. One can say is their major support. They are still correct. They are still correct. So they know that their range is from here to there. This counter trend line could have guided you to buy all the way into that resistance. Then after the break, you actually sell up until it comes all the way back to this low or even this support that is just there. So that will be your range. So once your trading range has been established, it means the market has finished the entire moves in that range. So after finishing the moves in that range, you need to wait for the market to break out of that range and start to move towards the next major zone. So right now, after we break out of this range, we are looking forward to the next major zone, which I showed you on the daily, which is this bottom here. Obviously, it won't go in a straight line. I hope you're now knowledgeable in that area. It won't go in a straight line. It will always go in channels. For example, I'm actually seeing that this is a new channel that the market has established on 1 hour. Touch. So currently, this is the channel. So the market can actually follow this channel up until it goes all the way where we're expecting. So if it comes here and touches this trend line, you can simply scale in more cells, stop loss above the trend line. Then we keep on holding up until we reach the highest maximum targets that we're looking at on the higher time frames. So I hope it's clear.